you're seeing, does it seem like international stocks are poised to outperform U.S. again?
Potentially, yes. We can get to that in a minute. The last thing I want to mention in the diversification story, though, is considering beyond just those traditional investment classes, thinking about things like commodities, real estate stocks. Those can be instruments or investments that can do well in a growth economy, and they can help buffer against inflation as well. And finally, alternatives. These are strategies that are becoming more accessible to investors that can help mitigate risk. They invest in a whole different set of ways. Like they can invest in areas like commodities or rising and falling interest rates, and that can be a nice way of diversifying away from stock market risk as well. Now, on the international question,
yes, sorry, I interrupted your train of thought there.
Not at all. Yeah. So, international stocks, tremendous year last year. Some of the drivers behind that, they had a good recovery economically and earnings-wise versus a couple of quiet years. And they were relatively cheap coming into this year as well. So our team actually was leaning more towards international stocks versus U.S. stocks for the better part of the last 5 or 6 quarters. That paid off very nicely for our investors. And in spite of the strong performance they had, the valuations are still very attractive. And they also still have good outlooks for the earnings and economy like we do here in the U.S. That is a trend that could absolutely continue in international stocks. In international, people sometimes conflate the country headline, right? Well, there's terrorists happening. That must be bad for international. Or I saw something happening in Europe. That must be bad for European stocks. It turns out the markets don't always tie back to those political headlines nearly as much. Just as one example, the major markets in Europe, France, UK, Germany, they all performed extremely well and much better than the US stocks despite some of the challenges they ran into. In emerging markets, countries like Brazil, South Korea, that were in all these tariff headlines, had tremendous returns last year. So I think it's important to separate the fundamentals of those individual markets away from some of the headlines that are out there and not just assume that there's bad international headlines. That must mean bad things for international stocks. Oftentimes, over the long run, they can both play very nicely together, both U.S. and international, and lead to a smoother return for investors over time.
I think that's an important nuance, or maybe just an important, theme to think about. That just because you see bad news in one country doesn't mean that that's not a country you might want to invest stocks in or invest in their stocks. All right, let's switch gears now. And you had talked about the Fed earlier, Yurian, and talked about bonds, and we'd like to talk about that with you in a moment, Naveen. But let's dig into what we might expect this year from the Fed and interest rates. So we saw 3 interest rate cuts in 2025. But as you mentioned, the Fed will have a new chair this year. Jerome Powell his leadership will end in May. So how could this leadership change potentially affect monetary policy in 2026, Yurian?
Yes, it potentially can because whoever is going to come in as the new chair, and we don't know who that's going to be. We know kind of who the contenders are. They are likely going to lean dovish because I think those candidates are all sort of in line with the U.S. administration and what the Treasury Department wants to accomplish. And so rates will probably stay low. And again, that's part of the run it hot theme for 2026 and beyond. But that doesn't mean that everyone on the Fed is going to go along with that. And I think what we're already starting to see a little bit is that you may end up with 2 separate camps. You have the camp of the status quo sort of PhD academics at the Fed who want to look at things like the Taylor rule and the balance between inflation and growth and calibrate a monetary policy on that basis. And then you might have a new camp that are more politically aligned with what the administration wants to do and say, whatever it is, we want to cut rates and we want to goose the economy. And so you might see a more fragmented Fed, which would be the first time we've seen that in many decades, right? I mean, Alan Greenspan, the maestro, Bernanke, Yellen, Powell, they've all run a fairly tight ship where you might get a dissent or two once in a while, but generally speaking, whatever the chair wants is what happens to monetary policy. And that may still be the case going forward, but we might see a fracture of, instead of 1 or 2 dissents, you might see, 5 or 6, and it'll be like a Supreme Court, kind of judgment where it is not at all unanimous. And I don't know what that's going to mean specifically, but for a Fed that's always been very independent and very monolithic and very powerful, of course, that's something that we should think about.
Okay, well, who is always watching interest rates, besides you guys, is the bond market. And there's been drivers of interest rate volatility in recent years: the Fed, federal deficit, inflation, that could continue to be top of mind for 2026. So, Naveen, where are you seeing bond opportunities in 2026?
Yeah, before we get there, so last year bonds actually had a very strong year. The bond benchmark most of us look at returned more than 7% last year, which is exceptionally well for a bond investment, which is relatively lower risk compared to stocks. So I want to put that out there. Yeah. And some of the trends that were in place last year, I think, could continue. So we already have yields that are much healthier than they were even just 2, 3, 4 years ago. So as rates have risen before the latest rate cuts, we have seen most bond yields rise, and that can deliver a nice income for investors. Now, my team typically uses active managers within our bond investments. These are mutual fund managers that are picking and choosing between different types of bonds they prefer versus the ones they want to lean away from. And what they're gravitating towards right now is mortgage-backed securities. So for some people, that brings back memories of 2008. That was almost 20 years ago, by the way. So
it doesn't feel like it.
Doesn't feel like it. That was almost 20 years ago. And since then, investors have learned a lot about investing in mortgages. It turns out investment-grade mortgages, like the ones I'm talking about, have been tremendous investments for investors. They did better than treasuries and corporates last year. That could continue into this year. So we're not talking about the subprime stuff people are scared of. Mm-hmm. And the thing that they're leaning away from right now is more the treasury part of the market. Mm-hmm. So treasuries are a phenomenal buffer if you get market volatility or the turbulence in the market. But if you feel like the economy and earnings outlook is pretty positive, maybe you have better opportunities in other parts of the market, whether it's corporate bonds or mortgage bonds. So that's how these managers are set up. And for the bond geeks out there like myself and Urian, if you look a little bit deeper, like what kind of maturity they're looking at, duration they're looking at, look at the intermediate part of the bond market. That's the 5 to 10 year range. The shorter end, the Fed is cutting rates maybe, so maybe those yields are going to fall not as attractive. And on the higher end, Urian touched on this earlier, if those higher end rates go up, that can mean a lot of volatility in those longer duration bonds. So for the bond geeks out there, the team that we're working with, they tend to focus more on the middle part of the curve.
The Goldilocks.
Part of the curve.
All right.
Well said.
Speaking of Goldilocks, terrible segue there, but let's talk about gold because Urian has written a lot this year about the uniqueness of 2025, right? And one of the unique things of 2025 was the decoupling of gold and equities, Urian, which obviously, means they both went up in tandem rather than one going up and one going down. So that led to record-setting gold prices this year. What sparked that gold rush, Urian, and do you see that trend continuing?
And just as a backdrop, when you look at asset classes that are uncorrelated to either stocks or bonds, gold is one of them. Commodities in general are one of them as well. And so for gold to be up 65% last year when the S&P was up 18% and the bond market aggregate was up 7% is remarkable. And last year, other than Bitcoin, basically everything went up. So it was a very good year for diversification. So there's a lot of things going on with gold. One of them is, again, as we mentioned earlier in the show, this geopolitical recalibration from a unipolar world order to a multipolar world order. You're seeing central banks buy gold bullion, I think as a diversification against the dollar standard. Mm. Not that people are thinking the dollar is not going to be a viable currency or even the global reserve currency, but if you think about other parts of the world and the somewhat adversarial nature that has been in play between the U.S. and China and certainly Russia and maybe a few other countries, those countries are trying to basically buffer their own reserve assets. And it's interesting that gold is now the second largest reserve asset behind the dollar, even above the euro now. So so I think of this as a recalibration. And of course, regular investors jump on the bandwagon. There's a sense about what we call fiscal dominance, where again, the run it hot strategy of fiscal deficits, a lot of growth, and then low rates at the same time might again bring back inflation, or it might ramp up the money supply, and investors want to find assets that are a hedge against that if purchasing power does end up going down. And of course, gold is front and center of that. I think it goes even a little bit broader than that. And again, we talked about commodities earlier. Commodities is the one asset class as a general asset class, and it tends to be energy heavy, that really hasn't done much of anything for some time. And it is one of the pure diversifiers in terms of correlation. And so maybe the gold trade broadens out to commodities in general. And actually, even today, nickel is up 10%.
Right.
And so you're starting to see that copper is now strong. Silver is at 75. And so I think that's a theme that we're probably going to keep seeing.
Okay, something to keep seeing in 2026. And, just like gold, Bitcoin also had a great year as well, primarily due to deregulation in the industry, crypto industry. But, that bullish sentiment has waned as of late. So just would love to get your thoughts on Bitcoin and crypto in general, how you're viewing it these days and the recent volatility and what you might expect for this year.
So Bitcoin started the year very strong. Obviously it was part of the election, the more crypto-friendly outcome of the election. So certainly crypto in general really ramped up. And we had some of this financial engineering of what we call Bitcoin treasury companies buying Bitcoin, issuing shares, and that was really part of the momentum that we saw for a good chunk of the year. And then Bitcoin peaked at $126,000 in October, and then it fell. It went to $80,000. Today it's around $93,000. My sense is that Bitcoin might take a rest next year. We have this 4-year halving cycle that we don't have time to get into, but nothing goes up in a straight line forever, and I think Bitcoin might just take some time off. And in part of it, some of the thunder for Bitcoin has been stolen by what we call stable coins, which are a no-vol version of crypto because of the Genius Act and what that means for crypto in general. And so I think there's just a little bit of a reshuffling. I'm still bullish for the long term, but it outperformed gold for a long time, and this year was a year of mean reversion where Bitcoin ended up down, I think, 6 or 7%, gold up 65%.
What a year 2025 was for sure. And it turned out to be, like we talked about today, a great year for most investors. And it does look like, as we talked about today, 2026 could also be another strong year. But I feel like we would be remiss without acknowledging that there were a lot of people who were not in the game this year, who were not involved in the markets this year. They were still on the sidelines in cash for whatever reason. And they missed out on those gains. They're probably kicking themselves, and they certainly don't want to miss out on any potential gains in 2026. So I guess I would ask you, Naveen, if you could talk about this, how you and your team are helping investors consider what to do with cash who, may still have some cash to play around with.
Yeah, I work very closely with the advisors here at Fidelity and helping them kind of discuss these topics with their clients. So some of the obstacles they run into, clients are hesitant. They always feel like there's, the market's at an all-time high. It feels scary to get invested right now. The valuations are higher. Did I miss it? But what we found time and again, getting into the market seems to be the hardest part of it. And once you're in, time is on your side. Over time, things tend to work out over 5, 10, 20-year cycles. The growth is typically there historically to support the investment decision. Now, the other challenge for investors is how much should I put into the market? And that's going to be different for everybody, depending on your goal, your risk tolerance, your personal preferences, your family situation. It's something worth researching, whether you do it on your own, maybe some tools on our website, or you talk to a financial professional, come up with an idea of how much you want to have in stocks and bonds and other investments. Once that's in place, I'll recap what we covered today, right? So it's about being diversified, not just focusing on a handful of names you see in the news, but thinking more broadly than that. For different parts of your portfolio, maybe having some individual names is exciting and maybe it'll pay off in the long run, but rounding that out with other investments in the U.S. stock space, mid and small size companies, go overseas, look at international stocks as well. They can have really good years here and there, and that can help balance some of the volatility in the U.S. stock market. And then beyond just your typical stocks, there's always the bond markets. We touched on how bonds can provide a steadier return when stocks get volatile historically. They better maintain their value or even raise in value when the stocks might be choppy. And lastly, we touched on some topics that maybe are not as familiar for many investors, things like commodities or real estate or Bitcoin or alternatives. For all of those, worth considering, but also worth doing a lot of research to get really comfortable and familiar with those. And that's a space where perhaps a financial professional might be helpful with some of those decisions to be had.
But be well-rounded. And for those people who say, when is the right time to get in? It's now?
Generally, yes. Sooner is better than later, usually, when it comes to investing.
Right. You certainly don't want to be looking back at the year and say, I missed a whole year.
Yeah.
All right. Well, we are almost out of time, but we always like to end with a lightning round and just sort of have a little bit of fun here and hopefully get your quick, unfiltered, and highest conviction ideas as well. So Start with Urian and we'll go down the line. First question, what surprised you most about 2025, Urian?
I would say, I've been through 12 cycles, but still the rapidity of the plot twist is still something that gives me pause. And, to Naveen's point, you gotta be in, because if you try to market time these things, it's impossible. And then you can't compound if you're on the sidelines.
Right. I would say the comeback from you call it the tariff tantrum, which was, I think, the quickest from an all-time high to, let's call it a bear market, back to an all-time high, fastest ever. So that was the anomaly.
Remarkable.
Yeah.
I'll go to the resiliency of the international market. So coming into the year, my team was expecting good things from international, but by outperforming the S&P by 15 percentage points, that was not what we had in mind. So the volatility of the tariff headlines maybe presumed tougher international, but no, they bounced back and even stronger than U.S. stocks this year.
How about investor takeaways for 2025? What do you think, Urian?
Earnings drive the bus, and earnings growth globally has been strong. And as long as that's the case, I think generally you want to be on that side of the market. And so the earnings estimates, Denise looks at this all the time, whether they're being raised or not, and for what sector and for how many stocks, I think is what will drive the markets forward.
Yeah, I think it was an interesting fine point on the historical data of uncertainty. So more often than not, the way you measure uncertainty, high uncertainty is actually more often a buying spot for equities rather than a selling spot, because by the time you have those uncertain environments, most of it's already priced in. So I think 2025 sort of put a fine point on that.
Yeah.
Okay.
I'd say related to both of those points, I think it's just a reminder that this last year showed us the fundamentals, the economy, the earnings, they matter more than the near-term headlines. Even though near-term headlines can lead to things like short bear markets, over the long run, over time, it is the earnings and the economy story more than anything else.
It is the fundamentals. Okay, biggest question mark in your mind for 2026? What do you think?
Again, it's interest rate risk, the term premium, which is the risk premium that bond investors want to earn for holding long bonds. Will that dragon come back? And it's come back occasionally. And so that to me is probably the top of my list for things that I'm watching that could upset this apple cart.
Okay.
How much inflation will decelerate? I mean, we've seen, goods bump up given the tariffs, but we're lapping those, and service inflation has actually continued to decelerate. So maybe there's a chance that it decelerates more than people expect, which allows the Fed to cut for no other agenda other than the fact that they can continue to renormalize rates.
And not because they have to.
Correct.
Okay, Naveen.
And for me, it's the job market. The first question I talked about with you, if the job market stabilizes or starts to improve, that can be even stronger tailwind for the U.S. economy.
Okay, last question. I can't believe we're on the last question. What are you most excited about for 2026? Urian.
Doing the show again in a year.
Yes, I love it.
I'm very excited about the international markets coming back. They've underperformed the U.S. for 10, 15 years. The developed market index, the IFA index, is now on a run, overcoming 15 years of sideways action. The fundamentals are strong. Their earnings growth is there. They're paying more of those earnings out back to investors via dividends and buybacks. And their valuations are like a 16 PE versus a 25 for the U.S. And at a time when there's concentration risk, it's nice to have good alternatives, and so I'm very excited about that.
I would say durable earnings growth. I mean, the interesting part to me is if you ask me statistically what concerns you, it's usually really good things concern me. Really high earnings growth, really high economic growth. Because Urian pointed this out earlier, usually you have that boom that ends in a bust. This kind of grinded out durable earnings growth that's not too strong, not too weak, kind of 10 to 12% is actually the sweet spot for equities. And in some ways justifies the valuation much more than you would think as an investor. Current valuations don't relate as cleanly as you think to next year's earnings growth. They relate to the durability of that earnings growth and the length of the economic cycle. So the more durable earnings growth is, we discussed the reasons from the tax cut to the CapEx cycle that usually leads to that pull through when corporate America spends, then they tend to incite demand. So that durability justifies the valuations and continues the secular bull market.
Right on, Denise. All right, Naveen.
She had a good Goldilocks answer there.
Yeah, she had that sweet spot. We've talked about sweet spots a lot.
So three things for me. I'm excited about CapEx, to Denise's point. I'm excited about purple pants from Urian. And I'm excited about ongoing earnings and economic expansion. I think that's going to be a key driver next year.
I hope everybody has gotten a shot, gotten a peek at your purple pants. I hope they've been able to get that in the shot today. Well, a nice way to end things, folks. Really appreciate your time and just such a fantastic, comprehensive discussion. And we were right on time, too. 45 minutes, so you guys really are efficient with your answers as well. If you would like to hear more from Yuri and Denise and Naveen and our other thought leaders about what they are watching in 2026, please visit Fidelity's 2026 Investing Outlook. Just go to fidelity.com/outlook, and there you are going to find free expert insights, analysis, and further guidance on the year ahead. Also, just a reminder that Fidelity is here to help. If you have any questions about whether you are prepared for what may lie ahead, you can call us, you can download our app, or you can visit our website to talk about your plan. Just before we go, quick plug, reminder that Marketsense is a weekly show. Yay, team. So if you enjoyed our discussion today, you can catch us live every Tuesday at 2 Eastern, with replays always available on fidelity.com/Marketsense and Fidelity's YouTube channel, as well as wherever you get your podcasts. So on behalf of Yuri and Timmer, Denise Chisholm, and Naveen Malwal, thank you so much for your time. Thanks for the pleasure of your time. We hope everybody has a great first half of the year, and we'll see you back hopefully in June for the mid-year outlook. Take care.